Federal Reserve officials saw the strong economy and faster inflation opened the door for raising interest rates this year, according to minutes of their December meeting released Wednesday. Participants generally noted that, given their individual outlooks for the economy, the labor market, and inflation, it may become warranted to increase the federal funds rate sooner or at a faster pace than participants had earlier anticipated, according to the summary of their discussion. At the meeting, Fed officials had a wide-ranging discussion of how to move policy away from its current easy stance, including when to start to shrink its $8.67 trillion balance sheet. Some were eager to start to reduce the balance sheet, which is another form of tightening monetary policy. Some participants also noted that it could be appropriate to begin to reduce the size of the Federal Reserve's balance sheet relatively soon after beginning to raise the federal funds rate, the minute said. That's faster than the last cycle. In 2015, the Fed waiting 2 years after the first rate hike to reduce the balance sheet. Officials said that cautious approach wasn't appropriate this year. Participants remarked that the current economic outlook was much stronger, with higher inflation and a tighter labor market than at the beginning of the previous normalization episode, the minute said. Several officials raised concern about the vulnerabilities of the Treasury market and how that could affect the shrinking of the balance sheet. But other officials noted the Fed has a new standing repo facility to backstop money market stocks. DJIA, minus 0.52% SPX, minus 1.20% moved sharply lower after the Fed minutes were released. The yield on the 10-year Treasury note TMUBMUST 10Y, 1.707% moved above 1.7%.